Stocks rallied on Friday, powering both the Nasdaq and the S&P 500 to new record closes and allowing the Dow to reverse all of the year's losses. This is the S&P 500's seventh straight daily gain, fifth straight weekly gain, and the fifth straight monthly gain. And in spite of the high unemployment rate and the ongoing coronavirus pandemic, investors continue to snap up major technology stocks. Just 5 short months ago, the S&P 500 was just over 2,100. The media was spouting fire and brimstone reports, warning that the S&P 500 could tumble to 2,000 in the near term. Instead, the S&P 500 surged a historic 56% since the March 23rd lows. It was not because of a surge in earnings or profits, but rather by a record 90% increase in the forward PE multiple. Today, the multiple is at about 26.795 based on the Bloomberg forward consensus. This exceeds the dot-com bubble high and is just shy of the all-time high hit in December 1998. What happens next? It's easy to say that stocks have never been more overvalued. That's likely a fact. However, the Fed made it clear that it will not likely hike rates anytime soon. This will continue to provide liquidity and easy financial conditions, which will cause even higher stock prices. With the S&P 500 now above 3,500, it will only take another 130 points to push the S&P 500 about 4% higher to 3630 by Election Day. That will make this rally the greatest of all time in both speed and magnitude. That's the greatest of all time, or the GOAT. While you ponder that thought, let's go take a look at the obstacles the markets need to conquer. So today we're going to look at a few charts and it'll be quick, so hang on. We're looking at the 20-year monthly on the spiders, the SPY. We're at this level here, 350.58. There really isn't a gap here. It's just a problem with the charts today. But we have exceeded that prior high back in early 2020. That's one favorable condition. But we still need to get above another level. And here it is. We've talked about the relative strength a number of times. That top there with the declining trend moving through here. So we did move above that trend line here in the latest move up to that point, but we still need to get above that level, this level, and near that level. It won't be easy. Let's go take a look at the Dow. And here's the 20-year monthly looking at the diamonds, which is the proxy for the Dow. As you can see here, we're at this level, not quite as high as a previous level there in early 2020, but we're moving on up. We're getting close. Again, back to the relative strength, and you can see this trend line moving down here. Now, we may have barely popped above that trend line, but we still have, again, this level here, then hopefully get near that level. Again, that's going to be very difficult. The Dow is not as evolved as the S&P 500, and so there's more to go. Let's go take a look at the Nasdaq. And we're looking at the monthly chart on the ONEQ, which is the Fidelity Nasdaq Composite Index tracking stock. And again, that's a proxy for the Nasdaq. We're at this level here, which surpasses the previous level quite a ways from there. But again, moving down to the relative strength index, everything's not so rosy. We still have this trend line heading down here, and definitely we've moved up. We have exceeded this level here, but we still have this level, and then perhaps maybe reaching toward that level. It's going to be easier for the Nasdaq because the Nasdaq has been very, very strong. But now let's go take a look at the weakest index, the Russell 2000. And we're looking at the 20-year monthly chart on the IWM, which is the iShares Russell 2000 ETF, again, another proxy for the Russell 2000. Looking at the price chart, we're at this level here, 157.12. Now, if I look at it in another perspective, this is what I see. A very large topping process. So we need to exceed this level here, and hopefully this level. It's going to be much more difficult for the Russell 2000 because it is the weakest. Moving on down here into the relative strength, once again, we see the trend line heading on down. So very weak, and it really needs to power up, because if it doesn't, we might end up with something like that, or perhaps something like this. And those didn't end very well, here or here. So keep your eyes out. And the other thing to watch is the VIX. The VIX is very sneaky if you've been paying attention the last few days. Don't let that get past you. Be observant. And for today, that's ChewDog Charts. Thank you.